And I just want to say a word of very warm welcome to all of my friends at the Canadian Construction Association. Thank you for joining us today. It's great to be with you. I, as well as you, I'm sure, am quite disappointed that we weren't all able to gather together down in San Diego. I was very much looking forward to giving you an update down there, but I must admit, I didn't really know what I was up against because having to give an update on all that's going on with respect to COVID-19 at the time would have been a real-time challenge because one thing that is true, there are many things that are true about our current circumstances, but sort of one overriding factor for the economics profession is that we are all very much in revision mode at the moment. And I'll get into that a little bit later in the presentation, probably quite earlier in the presentation actually, because it's the reality that we are up against. So businesses, government, associations, and analysts are all trying to get our minds around how this is going to impact the economy, where it is that things are really headed, what kind of shape are we going to be in when this thing is all over? Will it be over at any point in time? And many people are sort of bandying about those questions. And of course, as government responds, as business responds to all of this, there are almost daily announcements that do change the outlook in and of themselves, because some of those announcements are very hefty in terms of their impact on the overall economy. And so what I'm going to attempt today is to give a flavor of how the construction industry itself is likely to be impacted, particularly by all that's going on. But in order to get to that point, I need to really give you a sense of what's really going on at a world level, and then boiling that down to the industry itself, and then to the Canadian industry in particular. So for those of you who are watching my weekly commentaries at the moment, and by the way, if for any reason you got dropped off the list, we've got so many different requirements in terms of personal privacy that we have every year had to go through our list, and sometimes inadvertently we drop some of you off that list, and I apologize for that. We're trying our level best to keep up to scratch with legally where we should be, and sometimes you need to resubscribe in order to keep receiving that. But if you thought that I had just given up on doing that thing, guess again. I'm still cranking those out every week, and I am on a COVID-19 series at the moment that we're now 4 issues into, and I have no intention of stopping writing exclusively on the impacts of COVID-19 in those weekly commentaries. So just go to www.edc.ca to sign up for that again, and they will be delivered to you automatically. But as I've been saying inside of those commentaries, you know, it's interesting. We had many things that we were talking about as we were going into this particular episode. There was trade policy confusion on a number of different fronts. There was the US-China situation. There was Brexit that was going on. There was the Canada, US, Mexico trade negotiations and worry about whether there was actually going to be an agreement between ourselves. There was talk about climate change going on in the world. There were discussions about public debt and the banking system and the next recession, and all of these things were bubbling away ahead of this happening. And isn't it interesting how this has become so all-encompassing that we're not even talking about those other things right now? Those who had momentum in some of those issues are frustrated that this has become an issue that is so eclipsing in terms of its overall coverage. This is a global issue. It is a crisis. It's a pandemic. And as we all know, as we are talking to each other from our house to yours via virtual means, it's before us every day. The amount of change that we have actually had to absorb as a result of all of this. So that's the sense in which I've put this presentation together. And I'm just going to stop my webcam here for the time being, not because I'm shy or anything like that, but because I want to preserve as much bandwidth as I can for the actual presentation itself. So I'm going to do my level best to give you a global economic outlook in the middle of a turbulent time. And what I will say right off the bat is this forecast is as of March 12th. And of course, a whole lot of stuff has happened since then in terms of different announcements, the gravity of the situation, and so forth. And so we have actually instituted a different forecasting process so we can actually keep up with what is going on. Well, what is a summary of the things that we are actually looking at the moment? First of all, this is really the worst moment that we have had since 2008, 2009. And it is becoming apparent that even though that is what we call the Great Recession, that we are looking at a second quarter worldwide that is looking much more like depression level reductions in activity. Now, what I want to clearly say with all of that is that the first half of 2020 is really going to be the hard part. This is the part of the year where we are actually in a global recession, and we are being hit in two waves. The third bullet says there, China is definitely wave one. And so China was the place where it started. It got hit the hardest first, and now the baton has been passed off in wave two as the China effect spread to the rest of the world. And that's very obvious to us, but we have to think about the economy in those senses as well, because China is actually starting to pull out of things right now, and their migrant workers are going back to work in droves. The percentage of people that are actually back to work in China in a number of the key industrial provinces there, the producing provinces near the coast, those numbers are anywhere from 65 to 75%. And they had actually said that by the time March was over, they would be at 100%. We just don't have numbers that are up to date enough at the moment to know whether that was the case. So China's getting back to producing, but the difficulty is with wave two hitting the West, they're not going to have anybody to sell to because the supply chain interruption has shifted from China-based to globally based. And so China simply will suffer, I guess, in the second quarter of the year, lack of demand from other parts of the planet, parts of the planet that China is actually quite dependent on. So we're in a situation here where the fourth point is that all industries will not be hit equally. And this is where we have some specific comments to make about the construction sector as we get to the point of wrapping up the presentation. And you will see through that some analysis that we have done actually has some specific things to say about Canadian construction. Most businesses are going to need assistance through the third quarter of this year to get through what it is that they are faced with. And I'll wrap up with some comments on that as well. But we, as an organization that is facilitating the transmission of liquidity to companies in all sectors in Canada at the moment, need to be on top of this. And so my group has actually been writing papers advising our executive team and the rest of the government of Canada on what those magnitudes are likely to be. But it is inescapable that very substantial amounts of assistance are needed this year, and that those levels of assistance are a multiple of what they were back in 2009. And that's really saying something, because that was a point in history where new records were set for the amount of stimulus that was going into the economy. And we're looking at borrowing needs being almost twice now what they were back then. Back then in 2009, we saw an increase of special borrowing activity by 22% on top of the borrowing activity that had occurred up to until that point. And this was liquidity financing to get firms through this particular episode. Right now, our best estimates look like we are going to need double that amount of growth. So not a 22% growth, but a 44% growth to keep things whole. So inside of that, we really need to know, okay, well, what is all of this going to be about? How are we actually seeing what is going on and how are we able to forecast it? Well, before we get on to talking about the pattern of growth, we need to have some kind of an understanding of the magnitudes of growth that we are seeing here. So China is really the canary in the coal mine here, as it were, because nobody really knew the extent to which lockdown would affect the Chinese economy. And one look at this particular series is enough to almost make your heart go into spasms, because, you know, this is almost like turning the tap off on an economy completely. Here we have auto sales, which were down 80% in just 1 month. I've never seen anything like this, and that is a phrase that one could repeat right through this entire presentation. An 80% drop in things is a virtual shutdown of an industry, and that's what we saw happen to motor vehicle sales inside of China. Well, that wasn't the only thing. I mean, you could look at industrial production, you can look at electricity generation, you can look at a series like traffic density. There were aerial pollution statistics, you know, heat maps of the amount of parts per million of particulate that were over the Chinese cities. You can see those kinds of things and image them from satellites. And from 1 month to the next, it went from an area that looked almost unbreathable to completely clear. That's the extent to which shutdown can actually affect things. And so a number of Chinese indicators were down at least on the order of 20%, and this one is one of the more extreme ones. I've got a second series up for you here, and that's retail sales. And you might think, okay, well, retail sales went down, but that's a pretty nice bounce back here. That's not a bounce back, folks. This is month over month changes. And so we had an enormous drop in retail sales 2 months ago, and 1 month ago, it was an enormous drop in sales. It just wasn't as enormous a drop in sales. So that's a drop on top of a drop. And so you can add those two numbers together. A 5% decline together with a 10%, roughly 10% decline, gives you a cumulative decline of 15% over a 2 month period of time. Now, what we do expect to see as China is coming back to work again is a radical bounce above that line again. And that's the dynamic that usually gets forgotten. And that's why we need to have a chart like this. This is Peter's blackboard, and I'm going to do a little bit of drawing for you. And we've got our fingers crossed here that this isn't going to be totally confusing by the end. I've done a tiny little practice of all of this. But basically, the economy is like, I'm going to do my little professor thing here for a second, folks. The economy is like this. If we have, and I've already messed it up, so let's get rid of that and start all over again. If we have on this axis, we've got GDP, and along the bottom here, we've got time. And this is just a standard thing that you would see in university, and I've just lost most of you because you did enough economics to really hate it. The world economy would be looking something like this. You know, as we entered this debacle, the world was actually doing decently in terms of overall growth. There was no question about the fact that we had a slowdown that was happening last year. And it was a policy-induced slowdown as our messaging went at the time. So what happened was we had an economy that was quite robust. We had very strong employment growth, very low unemployment rates, and an increased rate of labor force participation. Wage increases were going up. And so the fundamental strength was actually there. But what was getting in the way of all of that was the policy confusion. You know, the president of the United States out there talking about, you know, throwing up walls and increasing tariffs, and actually doing that between themselves and China, and threatening to do a round of tariff increases with Western Europe of all places, you know, taking actual friend economies that we're operating together with in the G7 and saying, you know, we're not too happy about how you're doing things at the moment. We're going to slap tariffs on you. Just wait till we're done with China, and so on and so forth. And what does that do for an economy? Well, it shuts two things down. it takes investment and says, well, look, no firm, no company knows actually where to invest at this point in time. And secondly, everybody was very worried about international trade flows. So those two parts of the economy were slowing down at the same time as the domestic economy, the employment, the consumption, and so forth were going gangbusters. Well, what happened at the end of the year? We get to the week of December 9th, and we get a stage 1 agreement between China and the United States. Just weeks earlier, people were saying it would be impossible to get to that point. In the same week, we get the most definitive thing that has happened in the UK Brexit situation since the original referendum vote. So that referendum vote, as I've described to you folks in times past, the referendum vote was the most divisive thing in the UK. It didn't matter whether you were talking about Scottish results, Welsh results, Irish results, English results, results between the young and the old, results between London and the rest of England, results inside of the very parties themselves. So inside of the Conservative Party, all of these together were 50-50 votes in each case. They were very, very polarized. Any way you seem to cut the vote down, it was a terribly polarized vote. So that was the legacy of 2016. And right up until December 9th of last year, that was the persistent feature, let's say, of how Brexit was being carried out in the United Kingdom. Boom, December 12th comes along, and all of a sudden you've got a very decisive vote. That was the most decisive thing that has happened in this entire debacle. Boris Johnson gets in. He's one of the most popular leaders. Even though he's got COVID-19, he's one of the most popular leaders on the planet right now because he's taking the bull by the horns, being definitive about this situation, and creating some confidence inside of the economy. So those are three things: the U.S.-China Brexit situation. Oh, I forgot to mention that we actually signed our CUSMA agreement. The North American Free Trade deal was back on, and implementation is set for this year. There's some doubt about that, but it's not because the deal is in doubt. It's really because of what is going on right now. Well, that actually gave us a lot of optimism coming into 2020. Not us here, but the world. And the indicators had started to improve. So this blue line that we're talking about here was actually a real thing that was occurring. And so what then ended up happening? Well, we were barely into the year, and we get this drop in activity. And my drawing is terrible here, but the scale is not. We are talking about something very substantial that is hitting us all at the moment. And the difficulty with this is that we don't actually have a lot of data. The data takes anywhere from a month to 2 months to actually come into the system. And remember, it's only been a number of really days and really a couple of weeks that we've been in full shutdown mode. So the earliest data on anything that's going on is still going to be a couple of weeks out. That's what will give us the glimpses of how our economy is really being hit at the moment. But there are one or two ways that we can see what is actually going on here. And in this down period of time, there are staggering statistics that are coming out of the United States on unemployment insurance claimants. So just this morning, 6.6 million people in the last week have gone on to the rolls of the unemployed in the United States. Now you might say, well, that may or may not be consequential. No, in 1 week, to have 6.6 million people in the United States instantly go on to unemployment insurance it has never been seen before in the entire series. In the entire history of unemployment insurance in the United States, this blows anything else away. It even blows last week away, which was the previous record-setting element, which was 3.3 million. So it was half the rate, and it was a record-setting last week. We're not through this one, folks. This is a very, very sharp drop, and we're seeing a parallel with this in Canada. Okay, so this is the really stretched period of time that we are in at the moment. And so these this episode here is really the worst for us right now. But where are we going to go after this? I mean, we're not about telling you what's already happening and what you're aware of already. You know, what happens when we analyze previous virus incidents? And we've gone back to as far as the 1918-19 Spanish flu. We've taken a look at SARS, Zika virus, H1N1. And in fact, somebody very close to me sent me a text that showed me that almost in every year in the past decade, we've had an incident like this. It just hasn't been as big as this one. Well, what do we see happening out of this? Well, typically what happens in reasonably short order is that we get this huge uptake in the economy. And this is the part that nobody can believe. You know, just like riding a roller coaster in a theme park, you know, you're up at the top and you start going over the crest and you lose sight of the tracks. You know that the tracks are going to bottom out at the bottom of this. But as you're going down and as you're almost in free fall and you're not at terminal velocity yet, and every single instinct inside of your body is to protect yourself from what's going on around you, it's very, very difficult to believe that there actually is a bottom. And when we actually get to that, boy, there's a great big ramp up as well. You might say, okay, well, I'm going to believe that when I see it, Peter. You know, we've actually seen more of this kind of thing, you know, where you get to the bottom and then you just have this sort of measly growth off the bottom and you never really get back to things. And absolutely, that's been our experience in the post-Great Recession period of time. And so, you know, I can't fault you for thinking that way. But when we're talking about a virus situation that is happening, it always behaves very differently. Now, why would that be the case? Well, first of all, as people go back to work, that on its own actually gets things ramping up. Now, will people go back to work again? Well, certainly the people themselves want to go back to work again. Most people are not being fired. They're not being terminated. The businesses are not going bankrupt. In fact, they're being laid off so the businesses won't go bankrupt. They're trying to keep themselves whole so that by the time we come around the other side of this, they can start fulfilling orders again. And businesses have lots of orders right now. They've got order books that are fat and they need to fulfill those orders. And so the businesses want to open up again. They want to get their cash flows going and the people want to get back to work again. And as that happens, from what we can see happening in China right now, that is a radical increase in activity. And you might say, well, getting right back to the previous line, Peter, that's a bit of a stretch. You know, are you really sure that that's what's going to occur? I mean, that seems like the best of all possible worlds. Well, it's actually not the best of all possible worlds, because the difficulty with this situation is that if I can get this right, this period or this chunk of activity down here with the orange line is complete deadweight loss to the economy. So even though you get back up to the line, you've lost everything underneath the line. Now, is that reasonable? Well, people first go to, you know, reasoning like this. They'll say, well, you know, what about tour operations that shut down? What about airlines that nobody was flying in? What about hotels that nobody was staying in? What about restaurant meals that people were supposed to have over this period of time that just will never be eaten? You know, that is pure deadweight loss. What about those sports games that were going to be played and they're never going to be played? Okay, I grant you that some of what's in here is actually going to be lost. But over this period of time, not everybody is losing their jobs. Look at us right now. We're operating virtually. There are tremendous amounts of businesses that are actually able to operate virtually. There are other creative businesses inside of Canada, like the auto sector, that are saying, well, goodness, you know, we're not going to be producing and selling a whole lot of cars in the next little while. So why don't we all just go home and have a big holiday? You know what they're doing? They're saying to themselves, hey, look, we have a deficit of ventilators in hotels. Can we actually get a license to produce these things and tide ourselves over with pieces of work over this period of time? So again, we are seeing substitutionary effects that are limiting the amount of downturn that we see here. People are still at work. Now, for those people who are at work over this period of time, well, they are all still collecting a paycheck. Now, what's happening with that paycheck? Well, they're not able to spend it on their vacations. They're not able to spend it at restaurants. They're certainly not going to sports games. They're not commuting to work. There are many of their expenditures that are simply not having to happen. Well, their salaries haven't gone down for the most part as a result of all of this. Some are actually taking pay cuts in order to keep their corporations whole, but many are still drawing that same paycheck. They're continuing on their activities. So what happens when we are in the ramp up phase? It certainly encourages this phase of the line over here. But what we see happen in previous virus incidents is that we actually go over the line here, and then we come back down to it at some point in time. And so what is actually deadweight loss to the rest of the economy, or perceived as being deadweight loss to the economy, is actually recovered over this period of time. Now, my poor drawing makes it look like, you know, this period here is equivalent to the downturn, and that's not the case. That's not what I'm trying to push at this particular point in time. What I'm saying is we are always surprised on the upside when this thing starts to come back. And so what do we get out of all of this then? If this is the dynamic of the way that the economy is going to move, yes, the construction industry is going to be affected in the same way. Now, a particular difference for the construction industry is this, and that's that, you know, it typically reacts with a lag to the rest of the economy. It's hard to shut a construction project down. There are deliverables that are there. So half-built houses, people are still working on those things. Half-built industrial plants, same goes for those. And we are seeing that in the evidence at the moment, that's continuing. Now, I defer to you because you know much more about your own industry than I do. But as I'm scraping around for anecdotes and information on this, that's what I'm discovering, that there is a bit of a lag there. So you should be ready for that as we go forward. What are the two questions that we really need to answer for ourselves out of my motley drawing here at the moment? Well, they are twofold as far as we can see. And what we are trying to get a real good handle on here, folks, is what is the depth that we are talking about here? How can we calibrate that? Because as we go through the phase, particularly the down phase of all of this, we need to know how we can get ourselves from this point to this point over here without everything falling apart on us. How do we keep our businesses whole over this period of time? How do we actually hang on to those good people that we maybe tragically have had to lay off over this period of time for the sake of keeping our businesses going? And question number two is this: we need to get a handle on the duration. So this phase of time is the duration. So the depth in the green and the duration in the purple. That's what we're really trying to get our minds around. Now you might say, okay, towards the end of this thing here, you know, you've got this second recession that actually happens over here. Is that really what we're up against or not? Well, a key point to remember is that this blue line that I initially drew, the growth line, was not actually operating at the economy's full potential. So I would say, look, we're not going to have that recession because the world's potential growth or level of output is up here in the lighter blue line. So my sense here is that this point that we actually get to could be our new reality, and we would continue to grow off of that particular point when we get to that phase. I think that this episode might actually trigger the real recovery that we never saw at the end of the last recession. And that depends on whether we can really keep our cool or not over this very stretched period of time. So I think I just erased everything, and I didn't mean to do that, but I apologize if I did that. Anyway, this is that is really our characterization of what it is that we're going through. Okay, so how does that relate to reality? Well, our outlook is under revision. Global outlooks are under revision. So the OECD just a few days ago, let's say, you know, we're talking about 2.5 to 3 weeks ago, came out with their brand new forecast. And they walked away from those numbers almost immediately because things were changing so quickly. The IMF is in the midst of preparing or getting ready to release its World Economic Outlook, and they have telegraphed to the world that when they release the numbers, they are going to be ugly. The Institute for International Finance is a respected institution of global banks, and they have revised their global growth forecast down. As you can see on the slide here, they initially came out with global growth of 2.6%, which was not unreasonable. They revised that down to 1.6%, which is our current official forecast. The IIF has now come out with a minus 1.5% forecast. Now you can see that I've got here this, oops, I didn't mean to do that. So I'm going to get rid of all of that and start drawing again here, folks, because what you can see happening in this chart here, this might be hard to read for you, but that down there is 2020. That is 1 year. And look at what is happening inside of that year in their chart. You get this massive decrease in activity that's happening there as they go down the V. And then you get this massive increase happening all inside of 1 year. Now, that's key to our forecast. That's what I illustrated to you in my crazy drawing there that was going to happen. And here you have a respected international forecast that is saying exactly the same thing here, that inside of a year, you are going to have these very radical movements. Now, is that wishful thinking? It's not wishful thinking. One of the key reasons is not just people getting back to work, and it's not just pent-up demand, but as we analyze the pattern of incidence of COVID-19 around the world, we get to a point where it flattens out, and as it flattens out and starts to diminish, which we are seeing in China, and we're seeing the beginnings of that in countries like South Korea, in Singapore, Hong Kong, we see it in Italy now, and the very beginnings of stabilization inside of Spain. Well, inside of a 1 month to 5 week period of time, we are already seeing the effects that total lockdown has on even economies that have been very hard hit by this virus. That's a comparatively short period of time. And if China is already successfully getting people back to work, folks, that's what we're talking about here. We've got a massive drop in activity, and the drop in activity is absolutely required to get this thing under control. That's what puts us into recession. But what lifts us out of recession in a really big way is the, bearing the fruit, I guess, of all of that lockdown activity, the ability to go back to work. And it almost seems like the more severe the restrictions are, the deeper the drop in economic output, the more likely we are to be rushing back to work when this is all over. So how does this punish the Canadian economy? Well, Canadian banks have revised down their Q2 forecasts, and they're a little bit ahead of us right now. And that's a hard admission for me to make, but we've got a massive model that we're trying to crank at the moment, and doing that virtually has been quite cumbersome for us. So we got brand new computing power to enable us to do that. We're a little bit behind, but what they've come up with is not out of line with what we are thinking about the forecast at the moment. Anywhere from a 10 to a 30% drop in the second quarter. And I will just say, these numbers are so dramatic, I've never seen them in my lifetime, and I'm not sure that anybody ever has. It takes a very cataclysmic set of events to bring this kind of thing to bear on an economy. I mean, even when an economy gets plunged into war, you don't see this kind of a shutdown of activity. You see certain industries that go very slow, but then you see other industries that take their place, mostly in the manufacture of military goods and so forth. So the economy keeps going, but it's a very unusual set of events that will cause this kind of shutdown in activity. It's very much a moving target. And as I said, EDC Economics is doing our level best to change our processes to accommodate what's going on right now. And we are actually going to a weekly forecast at the moment. That's what we're setting up at the moment. So any one of you that wants to tap in on where our latest outlook is, please be in contact with us. Now you might say, are you that bad forecasters that you've got to revise every week? the main reason we got to revise every week is, first of all, we're getting new information on the extent to which things are going down. We want to capture that as soon as we possibly can and make the needed revisions. But more importantly, we are seeing huge stimulus announcements coming out almost on a daily basis at the moment. So by the time a week is over, we have a number of different things that we've got to factor into our forecast. So whether that's a massive plunge in oil prices or a plunge in other commodity prices, whether it's an increase in a country's quantitative easing mechanism or sharper drops in interest rates, we're now at the zero lower bound, so that's not likely to keep continuing, or whether it's another announcement of a shock and awe fiscal stimulus program, that's what we need to keep up on. So we need to have a forecast with a refresh rate of about a week to be anywhere close to reality at the moment. So I will say that our forecast is obsolete, like the other ones that came out around about the same time. That's a situation that we find ourselves in. But I do want to say that when we released our forecast on the 12th of March, or sorry, when we locked it up on the 12th of March, these were very radical revisions. So these aren't the growth rates that you're seeing here right now. This is, it says real GDP growth. This is the change in GDP growth. So we revised our forecast down for all developed countries by 1.7% overnight. And overnight, we revised our emerging market rates of growth by 2.3%. And you can't see it, unfortunately. I'm working in a format here that chopped off the bottom of my table. I apologize for that. We will make the PowerPoint deck available to anybody who wants it. But underneath the screen there, there's a minus 2.1 for the world. And that's not a drop of 2.1% in growth. That is how much we changed that growth. And folks, take it from a dyed-in-the-wool forecaster. That's all I've ever done in my career. I've never seen anything like this in terms of the speed of adjustment that we have had to make on our forecast here. So our forecast was barely days old. We had to vote on the probability of the forecast. And most of my team were saying, this thing's got about a 5 to 10% chance of actually happening. And we've never, ever done that before. I mean, if your new forecast doesn't at least have a 50% probability, then you might as well just scrunch it up and throw it into the ash can. And that's what everybody's doing with their forecasts at the moment. Okay, so what are our actual growth rates that we are seeing happen as well then? Well, the entire G7 is in a recession in our outlook, and we are going to be revising that down, guaranteed. So we had an overall developed country growth for this year of 0.2%. And you can see that the Eurozone economies, with the exception of the UK, together with Japan, are in outright annual decline. Well, that's going to happen right across the board now with our revised forecast. And so that's the bad news. Those downward revisions are coming. The good news is, as radically as we're revising those forecasts down, that is the first half of the year phenomenon. And in the second half of the year, the extent to which we are dropping is going to magnify the extent to which we rebound in the second half of the year. What does that do for our 2021? So we see the beginnings of this in the third quarter of this year, a big ramp up in the fourth quarter, and that spills into 2021. So we see the opposite happening. So look at the chart there. You look at the United States, 4.7% growth. That is way ahead of the US potential to grow. Canada at 3.8% looks ridiculous to many forecasters because, you know, we can sustain maybe 2% growth on an ongoing basis. And these numbers for Western Europe as well, their potential rate of growth aggregate in Western Europe is about 1.1%, just given their population dynamics and so forth. And these are eye-popping numbers even for them. It's been a long, long time since Japan has seen a 2.9. Going down a little bit further in the list, we got a China and India at 8.8% growth next year, and an overall world that's rising from a rate of 1.6% at our forecast in 2020, and that number is going down, and our projection currently is 5.3%. Well, the extent to which we revise down 2020 is the extent to which we're going to be revising 2021 up. And so that's what we really need to keep in mind in terms of the big picture. You might say, Peter, you know, that's just not the way the world works. You know, there's going to be a lot of discouragement about all of this. People are actually going to be in abject panic mode, and it's very unlikely that things are going to turn out the way that you say they're going to. When we go back to an event like SARS, which most of us can remember occurring, that's what everybody was saying when we were in the down phase of all of this. And admittedly, we didn't have the big shutdowns then that we had now, but we had a vestige of that happening inside of our economy as we hit panic mode. Most people didn't see us coming through this whole thing, and they were very surprised by the snapback that we saw. They were very surprised, additionally, by how quickly businesses were to jump onto airplanes and continue processing their business people to people at the end of this. Everybody's talking about technological displacement and all of that good stuff, and it just didn't happen to the order that people thought it would. The bounce backs are very radical, and that's what we want you to be as ready for as you are for the downturn that you're dealing with right now. It is a chore to get through this period of time. It is going to damage our bottom lines, but remember, we do have very, very significant stimulus programs that are out there right now that are helping us. Another factor behind our belief that the realistic forecast, not the optimistic forecast, but the realistic forecast is that we will have this bounce back, is that underneath all of that, we have a world economy that has pent up demand that is quite strong. And you've seen me show you this chart before, and I'm going to take you through it again. This is a count month by month along the bottom axis there of our experience, or the US housing market's experience, just prior to 2008. So the upper bars there are the extent to which surplus housing was created in the United States in the 2001 to 2008 period of time. And you can see that at the peak there, they had 3 million spare units in the economy. That's more than 2 years' supply. By the same calculations, and with the extent to which the US housing market has not recovered, there's actually a deficit that right now is as great as the surplus was prior to the Great Recession. And so this is a situation of very extreme pent-up demand, and we only just saw the US housing market recovering from this in the last few months. They jumped over that critical 1.4 million level in terms of housing starts. They haven't been able to do that since the Great Recession itself. That's the demographic requirements number. So them jumping up to that level has actually stopped the increase of the deficit. That's all it's done. And we believe that that number, once we're through this whole thing, is going to climb even higher than that, and that the US is going to be in housing recovery mode as we go forward. And that the jump up is actually going to give the industry confidence, and things are going to be going really well. You might say, okay, well, what's Canada's version of that? Well, unfortunately, we don't have one because we're in the opposite situation. This overage that you see right here is actually a mini bubble in the Canadian economy. We were a very balanced market back in 2008. So when housing starts collapsed in the United States, for Canada, they dropped from about 200,000 units a year to 150,000. If they had actually done the same as the US, they would have gone from 200,000 to 50,000. So we were 3 times higher on a relative basis than the United States collapse, and we recovered very quickly. And so from a balanced position here, post-2008, you see when we went through the crisis and we dipped for a bit, but we didn't take very long to start adding to the surplus again, and we actually never got below the line. You don't see any of those bars that are actually negative at that point in time, in spite of the carnage that was happening in the world economy. So over this period of time here, you get a whole lot of stimulus in terms of interest rate reductions, lots of government money coming into the economy. And of course, when you're balanced there, you know, you just grab that stimulus and you just go crazy with that stimulus. And that's what we've done over the last little while. So that's how we've built our bubble in the Canadian economy. So we are not actually in the same favorable position as the United States, and we're forecasting a mild correction to very stable situation inside of the Canadian economy. It's not carnage. We're not saying that this is going to be a terrible situation, but I just wanted you to know that our views on the housing situation in Canada have not changed from what I've been telling you over the last number of years. What about business investment? This is coming to a close real quickly here, but business investment, look, we do expect that actually this is going to be robust when the economy starts to pick up again. Why is that? Well, everybody's, once again, they've been brought face to face with supply chain risk and travel risk. And so those who are actually sourcing stuff from, let's say, Asia to produce a good that's essentially going to be sold in North America are already thinking about consolidating that production in the North American space. So Canada, the US, Mexico, coming together really to complete the supply chain and to mitigate the risks of actually being overseas and dealing with a remote issue like that. So I've actually had personal conversations with people in different industries, and these are the decision makers, and they are saying, yeah, you know, I think we've learned our lesson here. Well, they may do it, they may not do it when we get through the other end of this thing, but that's definitely what I'm thinking about right now. So they're clearly thinking about solutions like were talked about back in SARS days of nearshoring and reshoring their operations, and so that's come back into the vernacular again. What they need to keep their eyes on as well, though, inside of all of this is that demand is going to still be strong in these emerging markets that are overseas. And so if they've moved there for co-location and are really producing so that they can sell into those markets, well, that's the kind of activity that is not going to go down. But you should be paying attention to this nearshoring and reshoring, because you may have some really key construction opportunities inside both of these number one and number two issues that we see here. All right. What about this factor down here? Mechanization driving a domestic revival. Well, you know, it's interesting that just before all of this was happening, everybody was saying, man, I can't get my hands on labor. And you guys in the construction industry knew this better than anybody else. There's just a dearth of skilled labor. You couldn't find any anywhere. And many businesses were faced with the same thing. So we now actually have the technology to displace some of that labor. And I'm not talking about displacing labor that exists. I'm talking about displacing labor that we don't have. And it's a bit of a tricky way of putting it, but that's our reality at the moment, that businesses are looking for mechanization solutions because there simply aren't enough people. So they'll employ all of the people that they can get, but they're going to mechanize more. Now, what's the story behind mechanization? Well, it's as cheap to do here as it is to do in China, because the machine sellers are asking for the same price around the world. You know, make it in US dollar terms or whatever. Everybody's paying the same. So remote countries, Mexico, China, they don't have the price advantage when it comes to that. So if we're viable in doing things like that, then there is likely to be more industrial construction in Canada to support that kind of thing. And that's not just a fly-by-night kind of thing, folks. I believe that that is going to be a trend phenomenon that we see happening as the years go on. And clearly, as the economy reemerges, we are going to see those capacity pressures come back. And so that alone is going to put pressure on construction of new space, new square footage. They're going to actually need it. So on business investment, I am actually quite upbeat about what our prospects are when we get into that growth phase going forward. How about infrastructure? Well, I go to the Global Competitiveness Report for my cues on this. And you can see I've already colored in this diagram here, but I've actually blacked the numbers out, and I didn't mean to do that. So I've got a parallel presentation here that I can refer to, and I'll give you what those numbers are. Those what were supposed to be highlights there that became blotch marks in yellow there are illustrating the areas of greatest need. And you'll have to see the real presentation and see what I'm talking about here, but I'll explain it to you. In terms of things like the railroad density that we need inside of Canada, we are way behind most other nations, ranked 68th in the world. Our nation overall is ranked 14th, as you can see in the chart there. Canada is number 14 in the world. And you can't actually see it because the green line is through it, but you can see the numbers around it. We're number 14. We're number 68 in the world with respect to railroad density. With respect to liner shipping connectivity, 32nd in the world. That is not performance in a trading nation. We are 69th in the world in terms of electricity supply quality. Folks, these are key indications of infrastructure where we are behind the rest of the world. And as you can see in my scroll at the bottom there, 9 out of the 12 infrastructure categories are less than the overall Canada score and do poorly with respect to the rest of the world. Well, that's not a good situation to be in. And my next slide here shows the extent to which institutions have estimated Canada's infrastructure deficit as we go forward. So there are low case and high case estimates that are here. It doesn't matter because everybody is agreeing that we've got critical problems around the $110 billion level, and that's a lot of construction activity inside of all of that. So there are many in the policy world, the analytical world, and the business world that recognize how tangible this is and what need we have actually in Canada to be able to do something about this. Let's get clear of COVID-19, but let's not stop talking about what Canada's needs are. And please, please, please have your ear to the ground with respect to those as we go forward. So my summative comments here are, look, it's going to be rough and it's going to be very sharp, but it's not going to last for long. And we really do feel that by the time we get into the second half of this year, we're all going to have to fasten our seatbelts because nobody's really expecting that or preparing for it to happen. But that's a time when we can really capture a lot of growth that is out there. And for the construction industry itself, I do believe that there is a wave to ride along on that, just given the capacity situation that we're faced at and the deficit of need that we have and certain structural changes like the mechanization of work that we see happening at that point in time. Well, I've talked for an awful long time, and I certainly hope that we have a few minutes for Q&A, and I'm more than happy to talk or to answer your questions, and I will pass it back to you, Kenny, to administer that.
Thanks, Peter. We do have some questions as well, so I'll just read them out to you, actually. So this is from Peter from Aon, actually. What are your thoughts on a government-backed insurance fund, which bridges business interruption insurance and assumes COVID-19 as a recovered peril for policyholders who currently face pandemic exclusions?
Right. So we're very aware that certainly in the domestic space of Canada, which we have not played in before, as typically happens in a situation like this, insurers are pulling cover. And I want to assure you that on a daily basis, we are tabulating everything that we are receiving at the moment in terms of indications of the pulling of cover, and we are doing our level best to enumerate that and to make funds available for that as an organization. So many in the Canadian Construction Association know that at the annual conference, we've had our surety people around the table, and you know them by name. You've got great relationships with them. I would strongly encourage you to let them know what your experience is so that they can catalog that they can be aware of that, and they can work on specific solutions if needed. And if a general solution that we have already put together is what fits the situation, that's what EDC is here for at the moment. And our pledge is to help out as much as we possibly can. The federal government has also made funds available for this and has extended our powers so that we are not just confined to working with the export segment of the construction industry, but that we're also able to operate in the domestic space as well. I myself have done calculations about the duress on the construction industry, and let's just say that in terms of the amount of sales reduction that we are forecasting and the financial position that the industry brought into this, we are identifying it as a mid-level need industry. Every industry needs the support at this point in time, and the construction industry is right in there on our list, and we have flagged it inside of our organization. I hope that that is a sufficient answer for now, but I would say talk to your relationship manager, and if you don't have somebody that you can actually talk to, why don't you let me know that, phall@edc.ca, and I will plug you in as best as I can into our organization.
Awesome. Thank you, Peter. Just another question from John Boxtel. To your point, Peter, about lagging recovery in construction, the commitments are already in place for most of our backlog. The challenge for builders is waiting for owners to decide to make capital investments and then for design teams to produce. The impact of the pandemic will be felt for 6 to 12 months from now. Question is, how does this laggard effect get addressed by federal compensation programs?
Well, currently federal compensation programs don't have an end date to them, and they are designed to be something that tides business over the period of downturn in the economy. But they haven't actually put a time limit around that. They haven't said, well, you only have 3 months or you only have 6 months to access these funds. So this is going to be done on an industry by industry basis, as industries all do not operate at the same level of speed or cadence. And I would say that it's important that you register that that is the case, knowing that you have an analytical community that will completely back you up on making those kinds of assertions. And as I see programs being unveiled at the moment, the wording inside of those is very much, what are the needs of the industry? How long is an industry going to be underwater? And let's make funds available as much as we possibly can for the specific needs of the industry. So it's very important to communicate that out. And I will say that as an insider, I am very much instructing EDC that that is the way that things are going to be. I've already done internal presentations to this effect, and I'm doing presentations with senior government leaders and telling them exactly the same thing. So they're hearing it from me. If they hear it from you, that's proof positive. And it's just important to either speak yourself or have your association speak on your behalf. Let Mary do some of your advocating for you as well. And to let it be known that, look, these are the dynamics. And there's no person in the economics profession worth their salt that would argue that a delay is actually exactly what this industry faces at the moment. So there's a lot of backup for that view. And I would just say the more voices that are singing out of that same songbook, the more likely you are to get the assistance that's needed at the time that it's needed.
Perfect. One last question, just for sake of time, Peter. Any particular concerns, especially with the stimulus package and being out, about the government debt, the debt and the deficits in the government itself? Would that come along as well, or is that going to be something to worry for the future?
Worldwide, I am concerned about that. We're in crisis mode at the moment, and there are almost new revelations on a daily basis of the extent to which support is needed. So nations are almost universally doing business support programs. There are now very significant income support programs that are going on to maintain employment. And of course, the EI systems are going to be very taxed. But if we're right, and this is a short, sharp thing, then you won't actually get an annual effect of all of this. You're going to have a rebound. And while the cost fiscally is going to compromise the finances of every nation that has a stimulus program, it'll become a question of relativities. And thankfully, due to work that had been done in the past, over the past decade or two, on getting our fiscal finances to a very favorable global position, well, we entered this whole thing in a much more favorable position than the rest of the OECD. And so our programs are similar to the ones that are being announced in other countries as well. And so I would say that whereas we will all see some measure of deterioration, Canada will still maintain a more favorable position coming out the other end of this thing. That's about as much as I can say at this point in time, because we've got a study underway shortly that is trying to enumerate what those fiscal costs are going to be coming out the other end. Nobody's got any appetite for that right now, but we're trying to get ahead of that issue. It's a very good question, and we will be publishing numbers on that as soon as we possibly can. All great questions. Thanks very much.
Thank you, Peter. Just for the sake of time, so thank you on behalf of Canadian Construction Association, Peter. Thank you for those valuable insights. If there is anything to take, is there's a positive outlook amidst this gloom. There's lots of things coming. The economy is going to bounce back. I think the message is we need to be ready to actually be ready when that bounce actually happens, that spike actually happens, goes up itself. So on that note, thank you so much. Ladies and gentlemen, our next webinar on the series will continue next week on Thursday, April 9th on managing your workforce remotely with experts from KPMG. Thanks again, Peter, and wish you stay safe and stay healthy. And that goes out to all of us, all the attendees as well. Thank you so much.
Thanks. Good to be with you today, and take care, everybody.
Thank you.